What's up, guys? Welcome back to my personal finance channel. My name is Kyle Pepe, and today we're gonna be talking about timing the market. So if you're trying to time the market, don't. Yeah, that's really my best advice. This is how I do it. I don't. So I guess it goes back to the famous saying, it's not about timing the market, it's about time in the market, which is very true. I will have to say that my best position ever, between options and stocks, I guess my biggest return, right? Now, obviously, annualized, maybe not my best return, but at least in like overall return percentage, was holding Tesla stock for, I think, a 5-year period. So I bought 5 shares of Tesla stock back when it was trading at like $130 a share in like 2015 or something like that. And I held it until, well, now. And I think I invested somewhere around like $500 to $600 in those 5 shares. I guess it probably would have been closer to $600. And I think I had over a 2,000% return. That $500 turned into like over $15,000, something crazy like that. And that wasn't about trying to like time Tesla or time the market even. It was just about finding a company I believed in and that I liked and just holding it for the long term. And I think that sort of plays true to buying any stock right now. Like even Tesla, I think it's crazy overvalued, and I probably wouldn't buy more stock right now. I would wait for a dip. I would wait for a market dip, or I would look for another investment that, you know, might have more room to run. Now Tesla could continue to go up, right? Like if I looked at Tesla even a year ago or 2 years ago, I probably would have said the exact same thing. I think it's overvalued, and it's part of that is because the Fed and the government is just handing out money or printing money, which is causing assets to effectively have a higher price tag, right? Think about it. If there was an economy with me and one other person, I had a good and that person had all of the cash in the economy. Well, the most I could sell my good for was the total sum of cash in the economy. So if that person had $2, I could sell my one good for $2 because like I can't sell it for $5, otherwise I would never sell that item, right? However, if that person now was like, oh, well, I'm the government, so I can create more dollar bills. Now I have $5, or now I have $5 instead of $2. Well, now I could say, well, I'm gonna charge $5 for my good because, well, I have the only good in our little tiny ecosystem and they have $5, so I can say it's worth $5 now, and the only way they can get it is by paying $5. Now, obviously, they don't have to pay $5, but then they'll never get the good, right? So it kind of goes back to how the Fed is basically saying, oh, we'll print money, we'll buy corporate bonds, we'll do whatever we have to. And then the government's handing out stimulus checks. They're flooding the market with US dollars. So as there's more US dollars, that money can flow into other assets, such as stocks, housing, and whatnot. And I think it's causing a bit of a bubble, to be honest. Now, it may not be a bubble because, well, those dollars aren't just going to disappear a year from now. But the point is, the old way we value things may not be as relevant going forward. Now, on top of that, I think the biggest takeaway from last year, when the market dropped by like 50% last March, was that having some cash or some buying power ready to go is always helpful, or having bids in the market, right? Some limit buy orders, I don't know, 30, 40, 50% below where a stock or an ETF is trading. That way, if the market does have a one-day flash crash, or maybe it sells off that quickly in a 1-week period, just like last year, this time last year, you have bids in ready to go, so you don't have to think about it. Or if there's a crazy spike down in the market and you're not able to watch the market 24/7 because you have another, regular 9-to-5 job, that's kind of a great way to, I guess, get better pricing, even if you can't watch the market 24/7. So I would then say, instead of trying to time the market and sell the top and buy on dips, what you can do is take some profits. If you bought Tesla or NEO or some other energy companies, or really any stock last March, and it doubled in price over this past year, maybe sell half of it or 25% of it, or all of it if you feel like it. Realize some of those gains, and you'll have some dry buying power just in case we do have another market correction. If interest rates start to creep up and people continue to sell stocks, or some other crazy pandemic-like event happens, right? You have some cash on the sideline ready to go just in case we have another crazy downturn in the market. If the stock market drops 30, 40, 50% in a 1-week period, I would say go to town and buy as much as you can, right? That's what I tried to do last March. I had some cash. I was waiting for that market correction. We didn't see it for 3, 4, 5 years, but I had that cash ready to go, and that 50% correction was still better buys than what I could have gotten 3, 4, 5 years ago on some assets, right? So if you're looking for, dividend-paying stocks, dividend-paying ETFs, companies like that, you don't always see a 20, 30, 40% drawdown in them. So to see that this time last year was a great buying opportunity. So rather than trying to time the market perfectly, sell the top, buy the bottom, all that jazz, just look for a good buying opportunity. If stocks drop 30%, you may still want to wait, right? As soon as they start bouncing for a week, maybe 2 weeks, maybe then you look for things that are lagging and haven't fully retraced, right? That's what I did last March. The market sold off like 50%, and I bought stocks off the bottom. I think they were up like 20, 30%, some of them. And still, I think to date, to date from a year ago, I'm up 50, 60, 100% on some of those positions just because I waited. And even though I didn't buy the bottom, I was still able to buy them at a huge discount compared to where they were. So if you're afraid of a market correction happening, then take some of those big gainers off the table and have some cash ready to go in case we have another 40+% market correction. And that's kind of my best advice and what I've seen, being a professional trader for 2.5 years, effectively a day trader, and just trading my own portfolio, trading stocks, trading options, having that dry powder ready to go when you really need it is key. And then also using options, if you understand them, to help leverage some of your money, right? Then you don't have to deploy all of your money when the market drops 50%. You can deploy maybe 10% of your capital, but still have the same upside leverage, where if that stock then does rise, 40% from there, you can either exercise that option and own the underlying stock, or you can just take profits with the options in general too. So it's multiple ways to play the market, but instead of trying to time the market, it's about timing the market. And I hope you guys enjoyed this. If you did, please give it a thumbs up, subscribe to the channel, and until next time, guys, thanks for watching.